Greetings, I'm Keith Klein, the host of the VentureFizz Podcast, where I interview the most fascinating people in the tech scene. This is episode 319, and today's guest is Peter Berg, managing partner at M12, Microsoft's venture capital fund. I've had lots of investors as guests on the podcast, but I was excited to interview Peter because I've never interviewed an investor from a CVC, or a corporate venture capital fund. I'm not sure what the number is today, but according to a 2023 report about CVCs, it counts 1,100 active CVCs. Based on this scale, it is a very meaningful opportunity for entrepreneurs in terms of raising capital. Thus, Peter and I pretty much get right into the details towards the beginning of our conversation about the world of CVCs, from what they are, differentiators, strategic advantages of raising capital from a CVC, how to evaluate a CVC, and other topics. As previously stated, M12 is Microsoft's VC fund. The firm invests in seed, Series A, and Series B rounds of funding across different categories like cloud infrastructure, AI, cybersecurity, Web3 and gaming, vertical SaaS, and developer tools. In this episode of our podcast, we cover lots of great topics, like how Peter landed a first name @Peter handle on Twitter, or now known as X.com, a walk through Peter's career, including his investment into Square and the creation of Visa Ventures, which scaled to a global organization and went on to invest in Stripe LoopPay, which was a Boston startup that was acquired by Samsung, and many other companies. All the details on Peter's area of focus at M12 and what he is targeting for investments. Some sample portfolio companies at M12 like InWorld and Typeface. His thoughts and opinions on the current state of the market for raising capital, and so much more. Okay, quick side note. Is your company hiring? If the answer is yes, then you might want to add a VentureFizz subscription. It is our employment branding and hiring solution that helps to keep your company top of mind for our targeted audience of professionals in the tech industry. A VentureFizz subscription includes an employment branding page, unlimited postings to our job board, access to all of our exclusive employment branding content series, and more. Send an email to info@venturefizz.com to get all the details. All right, without further ado, here's my interview with Peter. Peter, thanks so much for joining us.
Thanks for having me. It's a pleasure to be here.
Yeah, I'm excited to talk to you. Well, there's a couple of reasons. One, I talked to a lot of investors for the podcast, but I think this is the first interview that I've had where I'm talking to someone who's part of a corporate VC arm, which you've had a couple stops along the way in that world. So I want to talk about that. But I also feel like I'm talking to a tech celebrity, because you have an @Peter handle on Twitter, which is phenomenal. So I wanted to start, how did you land that? Were you that early on with Twitter, or now X?
Yes, I was that early / that old. No, I started using it before it officially launched. I've always kind of been an early adopter, which is maybe why I'm in venture investing. But yeah, I heard about it through friends, I think, even before the media wrote about it, and just tried out the Peter handle. It was available, and the rest is history. But yeah, I used to hang out with all the early Twitter founders and the team. We used to actually go. There was they had a running group too. It was like Tweet Feet. We just would run through. It was like a running club through San Francisco with mostly Twitter people. So most of the founders at some point joined.
That is impressive. So
yeah,
you must get there must be benefits. I mean, you are still very active on the platform, and I was going through some of your posts, and they're very insightful, and some were humorous. Yet you still must get some followers that are probably looking for @Peter and thinking it's somebody else.
You were not wrong. Yeah, I do get DMs for. In fact, I recently just got one. It's like, how much for your handle? So it's not for sale. I don't know what the current terms of service are of now X, I guess, but it was selling them was against the terms of service. Not that I would even consider it, but yeah.
Yeah, too funny. Okay, well, let's get into something a little bit more on point here. So most of my audience, I think, know corporate VC as a financing vehicle, but I didn't want to assume that. So I thought it'd be good to do a primer of why do corporations have a VC arm? What is the primary differences between a corporate VC versus a traditional VC from the outlook of a company as well as a startup that's raising capital? So just like an overview of corporate VC and what is it all about?
Yeah, sure. As you mentioned, corporate VC, typically you've got one or sometimes more limited partners or LPs that are the corporation. So in M12's case, which I work for M12, I'm a managing partner at M12, which is Microsoft's venture arm. And I've also previously ran Visa Ventures, which is their venture arm. So corporate VC or CVC is basically venture capital, but just where your investors or either primary or exclusive stakeholders are one or more corporations. So in our case, Microsoft is our sole LP or limited partner, i.e. sole investor. And we invest off the balance sheet into early stage companies, primarily seed through Series B. But to your broader question, I mean, I think there are as many flavors of CVC as probably there are corporations that do it. And I think everyone, each corporation has their own objectives. For the most part, what we do at M12 is both, investing for, we're trying to really find emerging technologies and like the most interesting, transformative companies in the technology sector to invest in, and then also create meaningful relationships with them, right? So M12 is evaluated both on financial returns as well as strategic impact. So our leadership is quite clear. We're here to make money and not to lose it, right? And not just to do token investments for strategic reasons. We're actually trying to find really best-in-class companies that are good standalone companies, independent of any association with Microsoft. They have to be a good standalone venture scale business that we want to invest in. And then in addition, we also look for ways to work with that company. So I think CVC is often, well, a lot has been said about CVC. Sometimes it's maligned. And I think actually CVC can be a superpower, frankly. Now, granted, I've been part of 2 of them, so I might be a little bit biased in this direction. But, the joke with VC is often like, oh, let me know how I can be helpful, right? And like, that's almost a cliche at this point among founders. It's like, oh yeah, VCs, they're all selling money and they're trying to differentiate themselves, right? In our case, like with CVCs, we actually can be helpful. Like we have concrete ways and quantifiable ways that not only we can, but also have added value to our portfolio companies and worked with them in meaningful ways. So I actually think it's kind of amazing, right? To have the backing and like the resources of a large corporation that you can tap into when necessary without, in our case, we do not require companies to work with us or to have a commercial arrangement with us or to get executive sponsorship to do a deal, which is actually very, very nice. And I feel like M12 has as close to the ideal setup for CVC as I've ever seen. I have some opinions having done this twice now. And I think we've set it up really well where we really try to add value and like do right by our startups without requiring any unnatural acts of them, right? We don't make them work with us prematurely or, as a condition of investment, but we do really look for ways to engage with them and to partner with them and also accelerate outcomes with and for them, right? So that can be like go-to-market assistance, product partnerships, any number of different things. So to me, that's actually a huge benefit of CVC. And if you're a founder, a reason to consider taking money from corporates is for that relationship. Although I think, just advice to founders is like really understand like how that CVC is structured, what motivates them, like, and what their process looks like, because not all are the same, right? I think we try to run a streamlined, independent process at M12 where we make our own investment decisions. We don't require executive sponsorship, but we work very hard to build bridges into Microsoft so that accrues to the benefit of our portfolio companies.
So what would be some of the like potential pitfalls that founders should be on the lookout for dealing with a corporate venture capital arm?
Yeah, I think, again, it depends on the company. So I don't want to paint with too broad strokes, but I think just some general things to be aware of or look out for as a founder. How is the CVC measured, right? What are their goals? What are their objectives? I think in our case, we're very fortunate that we're both aligned strategically as well as financially, right? We're looking for good financial outcomes. And so that aligns incentives with the founders. If it's just strategic insight and they don't care about financial returns, like that can sometimes lead to the corporation wanting certain things that the founders may not prioritize as much and might not be the right thing for the business. I think the other thing to think about is like, what does the process look like? Who needs to sign off? Fundraising. I've been on the operating side actually most of my career, not versus the investing side. Fundraising is a huge distraction from building, right? So you want to be ideally like do it as quickly as possible and then get back to building and like focus on your core business. Like your core business is not fundraising. Hopefully, it's actually building something of use. And so just understanding what the process looks like, what the timeline looks like, what gates you need to get through, right? What kind of approvals you need, like that kind of stuff. Again, we're fairly fortunate to have a streamlined and like independent governance process. We've got great support from the top down. I think that's the other thing is like, where does, how does the CVC operate within the company? Like, what's their relationship with the parent company? Can they actually move the needle for you? Like, are they able to do what maybe you guys envision? And I think the other thing to understand is like, do they require a commercial agreement? Do they require some sort of, do you have to be built on their tech stack? Do you have to have a business deal with them to get investment, right? Like figuring that out up front, really it would be wise as a founder. Again, we don't require that, but we look for ways to like build that over time. And again, like in a way that is right for the business. I've seen other corporations sometimes do things that are inorganic, I'll call it, right, where they require you to do certain things, move to their tech stack, et cetera. And like that might not be the right thing for the given stage of business you're at.
All right, well, let's rewind the clock. So where did you grow up? What were you like as a child?
Oh, wow. Going way back. Okay. I grew up in Southern California. My mom was third generation or is third generation Californian, which is, I feel like, sufficiently rare. Most people are either coming or going. My dad was an immigrant. He came from Germany. And so as a child, I don't know, I was fortunate to have kind of see a bunch of different things, traveled a bunch to Europe and other places. As a kid, like I was always just very curious. I loved math, science. Like it was very curious. It was like tinkering. I wasn't, and I had no idea what I was going to be when I grew up. In fact, like when I was, I think in fifth grade, I was in this class, and they asked us like to design a business card for like your future job, and I could not pick one. So what I invented my own, and I called it, problem solver. So I had made this like little business card where I was
That's
like,
cool.
I'm a problem solver, had a little light bulb on it. And I think looking back, like I didn't, now with the benefit of hindsight, I think I can appreciate it differently. But like, I think that's kind of what I've been doing a version of that ever since, either building product or like finding interesting ways to connect the dots. I think maybe that's why I like CVC, because it's not just investing. Like it's like investing with an extra level of difficulty. Not only do you have to find good financial investments, but you also have like ideally are looking for things that are strategically aligned to what the LP looks for. So yeah, anyway, that's the little I don't know how much of my childhood you want to delve into, but those are the cliff notes.
Well, what led you down the path of studying mathematical and computational science and then statistics at Stanford?
Yeah, well, that's a good question. I have so many different interests. Like I've always been curious and really like exploring different domains. And so I started off like down the physics path, and then I realized like I am not a physicist. Like people who do physics for a living are like a different breed. I respect them, I admire them, but that is not me. But I've always liked applying science and technology to solving like real world either questions or problems. And so mathematical and computational science, I think they may have renamed it now, but like it was and is an interdisciplinary major. So it allowed me to take a bunch of different classes, from everything from economics to math to CS, to statistics, and combine those. And then I got a master's in statistics, again because I wasn't into theoretical math, like math for the sake of math, but rather applying it to solve problems or answer questions. Right. So that's what I loved about those domains, is like you can actually use numbers to answer, questions in the real world that people care about. Like one of the projects I did when I was for like my senior thesis was not a thesis, but like one of the projects for a class was to estimate the male to female ratio in like Bay Area and surrounding bars, right? Because in the Bay Area, there's a joke, I don't know if you've heard it, like where the odds are good, but the goods are odd, because there's so many nerds out there. And so I was like, well, how good are the odds actually? And so I was like, well, let's figure it out, right? And so I mean, it's kind of cheeky, but it's like that's the kind of stuff where like people don't think of that as a statistical problem necessarily. It's more of like a cheeky kind of dating question, but it's actually, you can answer it with math, right? And so very nerdy approach.
That's awesome. So how did you get your career started?
So before this cool thing of data scientist was invented for all these tech companies, there were like two tracks. There was like insurance, like there was like research for statisticians. So I became an actuary actually. I was a pension actuary, but I guess I've always liked kind of pushing the envelope or doing new things, even in like staid or maybe traditional fields like actuarial science. So I was very fortunate to land at a kind of a boutique company that had a pretty forward-thinking approach. So we actually created a tech platform. Really, we created SaaS platforms before SaaS was a kind of a ubiquitous term. We took a very manual, highly paid, expensive actuarial talent, jockeying Excel spreadsheets was basically like the product. We were selling our services. And so we were like, well, what if we turn this into software that you could automate this design of like tax optimized plans. Long story short, built an online platform, first of its kind, to automate and scale these things. And that was ultimately acquired by JP Morgan. And then I didn't really want to stay there for an extended period of time. So I left shortly after the acquisition. And then kind of from there, I think I had my taste of like technology and building software, and really like from then on kind of stayed in that world.
Yeah, you had to stop at Joby. So what did you do there?
Yeah, a friend of mine kind of recruited me into there at the time as I was leaving JP Morgan post acquisition. And so Joby is still around. It's been acquired since, but we were building a thing called, it was my one foray into like consumer products. So we were building a thing called the Gorilla Pod, which is a flexible camera tripod with like bendable, wrappable legs. And that thing was just it was like amazing. The founder had actually invented it in grad school, and had always wanted to commercialize it. And so we basically, started commercializing this thing, and it was amazing. It was a great ride, and that thing sold like hotcakes. And while there, I helped like launch new product lines. I went to China, helped open their sales office in Europe, and establish our sales operations there. And then also that was right around the time when the iPhone was had been released, and so we actually developed the original camera app on the iPhone was pretty bare bones, let's call it. I mean, it was like had a shutter that would like close and then open again. It was like this skeuomorphic design of like an actual shutter closing and opening, and your one photo would like take a while, like a couple seconds to like save in the background. It was a very slow process.
Wow,
So
I don't remember
as photographers,
that. Okay.
or like people who are selling photography accessories were like, this could be better. And so we built a camera app that basically has all of the features you have in your camera app natively. We built in like 2007 or 8. I think it was 2008. And then we released it kind of as a marketing thing. That thing got over 1 million downloads in like less than 3 weeks. I was just Apple actually featured it as a featured app, which was kind of amazing. I got this call from Apple on like late on a Thursday, and they're like, could you get us collateral by tomorrow morning? I'm like, sure, no problem. And they're like, no promises, but we think your app is interesting. And then sure enough, it was like a featured app over the weekend. So it was great.
Well, that's interesting because that's like validation of, I don't know how they do it now, but that in the early days of the App Store, you had no idea that it was going to be featured,
Yeah,
whether if it was
absolutely.
featured in the App Store or one of their television commercials. You had no idea, and then all of a sudden you're like, "What?" And you're getting
Yep,
all
you
these
just get this
downloads.
call or email and like, hi,
Yeah.
we noticed your app. Can you send us some things? And we're like, sure. Like I was like, I called my designer. I was like, drop everything. But yeah, so it's fun. But then from there, I went back into the kind of the SaaS and the fintech SaaS world, and did more SaaS startups. So
All right, then off to your first stop in corporate venture capital. So, what led you to Visa?
yeah, I was self-employed at the time. We'd started another company, kind of. I think we had sold to JP Morgan. They didn't really know how to scale it, and so there was a huge market opportunity still. And so we kind of built version 2.0 of that, and that was going along, humming, and was doing great. And then I met over a dinner party, actually met some senior executives at Visa, and started talking about their latest acquisition, kind of like payment strategy, where the world was going in terms of digital payments. And they were like, "Oh, how long have you been in payments?" I was like, "Oh no, I just find it a fascinating space. I'm not actually in payments." Like, they're like, "Well, would you like to have a conversation?" I was like, "Oh, I'm not really. I'm like happily self-employed. Like, it's fine." But I just had a series of conversations, and it was really interesting. It was a fascinating time for payments. It was kind of this intersection of technology. Like now, it's like people take it for granted, fintech and payments, all these things like Stripe and Square and all these companies just like are huge companies. At the time, they barely even existed, right? They were still an idea. And so I was very interested at the intersection of, again, kind of interdisciplinary things, right? So the intersection of payments and technology. So I joined initially in product strategy, And actually, they had just shortly after I joined, we had made an investment in Square, and obviously some folks at Visa saw the vision and obviously made the investment, but a lot of people were like, why are we investing in this company with this dongle and like flea markets, like anyone that can accept a credit card already does today, like this is ridiculous. I was like, no, I'm pretty sure they're onto something here. Like, and so I managed the strategic relationship initially for several years with Square, and we did, some amazing collaborations came out of that. I mean, we did a whole bunch of stuff together, and I think it made both companies better, right? We got insight into the stuff that Square was seeing firsthand. Square was getting the benefits of our expertise. Like there's a relationship with banks, like a whole bunch of other stuff that the network could provide that they otherwise couldn't really access effectively. And that, I think that's a good example of like, I've had a long-standing thesis, and it was kind of further cemented by the work we were doing with Visa and Square, and then subsequent work, venture investing. I've had a long-standing thesis that if you can marry like the innovation, the agility, the creativity of a startup with like the scale, the resources, and kind of the access of a large company or an incumbent, magic can happen at that intersection, right? And I think oftentimes they're speaking very different languages. And again, like there was a huge faction at Visa that was like, what are we doing with these people? Like, why are we even giving them the time of day, let alone investing, right? But there were enough people and enough momentum, and senior leadership understood it. And they were like, no, this is actually additive, right? And it was mutually beneficial. And I think that's, you see this with like Microsoft and OpenAI. I think it's like that is a transformative relationship. It's there are a bunch of other. There aren't that many like really shining examples, but I think that if you do it well, it's not, it's much easier said than done. But if you do it well and you marry kind of the innovation of the startup with the scale and resources of the incumbent, you can really do transformative things. So I, was fortunate to be at the intersection of a few of those at Visa and, here at Microsoft as well.
Now, did they always have a venture arm, or is that something that was just
They
created
did
while you were
not.
there?
Yeah, so the investment in Square was done sort of through the corp dev team. Like there was no dedicated venture arm at the time. They had done some investing in the past, but it was not really a dedicated program. And so we had a new CEO come in, Charlie Scharf, who's actually on the Microsoft board, as it turns out. And Charlie was really, he'd come from the East Coast, and he really wanted to lean into the Silicon Valley. I guess the fact that we had all these major tech companies basically in our backyard. So Visa is actually headquartered in San Francisco. And we historically they had only seen, the Microsofts, the Googles, the Apples of the world as merchants processing payments, right? They didn't see them as like strategic partners. And so the team that I was part of really leaned into establishing better relationships with all the tech companies, from the very large, companies that I mentioned all the way down to like the long tail of startups. And there was an appetite at the time to really start investing a little bit more proactively. And so I raised my hand, and basically we spun up a venture program, structured and basically created what is now Visa Ventures, created a program and to systematically and like intentionally invest, and designed a whole like program around it, strategy, like thesis driven investments, and then I basically led that and scaled it up into a global program by the time I ended up leaving. And we did some really interesting investments. I mean, Stripe, we invested in them, Marqeta, Chain, which it was actually the first investment as far as I know, the first investment in a blockchain company by any major payments network. And actually, I introduced them to a number of folks inside of Visa, and that actually catalyzed a whole nother set of conversations that led to a net new product that Visa ended up building, which was Visa B2B Connect, which is like a huge bet that they've made now on the commercial side of the house. Visa is a huge retail payments network. Most people don't know it's really a consumer payments network, but they have very little, or they had very little volume in B2B payments. And so that startup, incumbent collaboration ended up spinning out a product that is now live in over 100 countries, doing multiple billions of dollars in transaction volume, and probably wouldn't have existed had it not been for that investment. So I think that, again, like back to my thesis, is like if you marry startups with incumbents in productive ways, like magic really can ensue.
Yeah, and I saw one of the investments was LoopPay, which I remember from the Boston tech scene too. So
yeah, LoopPay ended up becoming, we did that deal, and originally we invested, that was the first investment we made actually under the formal Visa Venture structure. And that we did that alongside Samsung Ventures. They ended up acquiring the company, and it became formed the basis of that team formed the basis of Samsung Pay. So it was nice that you knew those folks.
Yeah, very, very. I remember the acquisition and everything. So
Mm-hmm.
good outcome. All right. So what'd you do next?
Well, I was at Visa for a while, and then I really enjoyed that. It was a great ride, but I got the itch to build again, and so I'd been there for 6 years, and I actually tried to invest in this company called Very Good Security. I wanted to do their Series A, and a financial investor came in, took the whole round. There was no allocation left for us, and I was like, oh man. So I stayed in touch with the founder. I ended up leaving Visa. I was trying to figure out what I wanted to do next. I was like, I probably want to go back to the startup world and build something. And then I reconnected with the founder of VGS, or Very Good Security, and I still loved the idea. I loved the problem that they were addressing. Basically, VGS essentially helps businesses maximize the value of their sensitive data. So if you think about like, if you don't want to get hacked, or if you want to achieve like PCI or other types of compliances easily, the best way to do that is not have sensitive data in your environment, right? And then there's a whole bunch of stuff that you just don't have to do because it's not in your, instead of shoving money under your mattress at home, you put it in a bank vault, right? It's like purpose built to hold sensitive things. And then you can use remote controls like to direct the value different places, right? Just like we do with your money in a bank. I can use a mobile app or something else to like move funds here and there. VGS does the same thing with data, essentially. They have a specialized vault for sensitive data, mostly fintech and payments data and PII data, and then allow companies to have full access and use of that data without the risk of holding it themselves. So we've got customers range from McDonald's all the way down to really interesting fintech startups and everything in between.
Oh, let's bring our audience up to speed on, we kind of talked about this at the beginning, but M12.
Yeah.
So what's stage of investing are you focused on? Is there a particular like thesis or vertical that you're aligned with for you specifically?
Yes. So M12, as you noted, Microsoft's venture arm. My team looks after investments in B2B SaaS primarily, as well as AI, Web3, and gaming. So within B2B SaaS in particular, we focus on retail and commerce enablement, financial services writ large. So that's payments, insurance, capital markets, as well as supply chain and manufacturing. So those are the kind of the primary verticals. We've also done some healthcare investing in the past. And then, of course, we also are very focused on AI and how AI is transforming how software gets built, and also AI core technologies that are enabling new innovations in AI. So we've actually we have a long history of investing in that space, even well before this latest type cycle. We've had quite a AI portfolio, but I mean, my primary focus is B2B SaaS in those verticals as well as AI.
It's Series A, Series B?
Oh, sorry.
Mainly, or?
Yes, absolutely. So seed through B, primarily Series A and Series B. That's to my earlier comments, we look for ways to be able to add value and to really work with our startups. And so that tends to be best aligned to companies that have some initial traction. They have early product market fit. They know who their customer is, right? They've got some sort of sales motion that is repeatable. And that's where we can really add fuel to the fire. So we'll engage as early as a seed stage investment, but our primary sweet spot is kind of Series A and Series B.
Got it. Okay. So what would be some examples of some of the portfolio companies that are under the M12 umbrella?
Yes, some of the companies one of the companies, as an example, is InWorld. So they are in the gaming space. So they power non-playing characters in games, NPCs, and they're sort of an AI-powered brain. You can think of them powering NPCs in games. And so we actually announced recently a multi-year co-development partnership with Xbox. So this is to the earlier point of like looking for ways to work together over time. That was not contemplated on day one, right? Like that was through the work of, the Xbox team, M12, InWorld, all collaborated, and a lot of work went into that ultimately to do a product partnership. But InWorld, does really interesting things in terms of like AI enabled gameplay and NPCs. And so you can kind of think of it as a character engine that can enable entirely new forms of gameplay and narrative within, like, dynamically generating. So One of the ways I like to think about this is like an infinite choose your own adventure. If you remember those books from back in the day, like you can each gameplay can be unique and different and can be contextually aware based on what the gamer is, how the gamer is interacting with the NPCs in the game. So never quite the same thing twice. So that's one example. Another recent AI investment that we made was a company called Typeface. So they're a generative AI company, and they really focus on helping enterprises, so businesses, use AI to create marketing, collateral, images, text, a bunch of different types of media that is in keeping with kind of the enterprise voice and their brand, right? So if you think about generative AI is very new and novel and very creative, but if you're a business, you want to do that in a way that is in keeping with kind of either the brand image or the voice that you have, and so Typeface enables companies to do that.
So how does an entrepreneur get on your radar? Like what's like your process typically?
They through good deals can come from a lot of different places. We work closely with a bunch of other investors who we co-invest with. They could entrepreneurs are always welcome to reach out directly. As you mentioned, I'm Peter on Twitter. You can also just email me at Peter Berg, all one word, at m12.vc. And then we do a lot of we'll do proactive sourcing as well. So we are thesis-driven investors at M12, which means we talked a little bit about kind of my focus areas, my team's focus areas, but we start by kind of having a thesis in certain domains or industries, and then go out and proactively look for companies that are solving those problems or addressing those opportunities, as well as inbound, and when warm intros are always welcome as well.
And if someone is able to like land their first meeting with you, like what do you hope to get out of that first initial meeting with a entrepreneur?
Yeah, this is a good question. I actually recently tweeted about this. I think if you're meeting, just general advice for founders, if you're meeting with an investor, like clearly articulating your value prop up front. We look at hundreds or thousands of companies in a given year, and so really quickly understanding what it is you do, what the opportunity or the problem is that you're addressing. I'm always looking for to get a really clear understanding of that, and I'll never be as close to the problem or the opportunity as a founder is. So I think really I want to, as quickly as possible, really understand like why are they choosing to spend their time on this particular issue, right? Like time is, I think, our most valuable asset. So what are you building and like why? And then I'm also looking for, trying to quickly assess from that, how big do I think the market opportunity is? Like, is this aligned to our thesis areas? Is there a way that I can, potentially work with this company over time? And I'm also looking for kind of the caliber to get a read on the founders, kind of how hungry, how aggressive, like how, what's their domain expertise? Like, why is this the problem that they're choosing to spend all their time on, right? And what do we think the business opportunity around it is?
No, are there other, we talk about benefits of working with a CVC, like with Microsoft, you'd be like, I could build on Azure, right? Like the cloud, and like, do they get like special access to that? Like meaning like there's, part of the investment is I don't have to spend money on my cloud provider, like.
Absolutely. I mean, so there are a range of benefits from working with M12 and Microsoft in general. So we also work very closely with colleagues in Microsoft for startups who have, it doesn't require investment to be part of our Founders Hub, which is I guess the startup program that they have for early stage companies. And through that, you can get access to Azure credits, so cloud compute. We also, M12 in particular, recently announced in partnership with Microsoft for Startups, access to GPUs, which are, these days are in short supply. So we have a dedicated cluster of GPUs for high potential AI companies that are early stage. We're initially making that available to Y Combinator and also to the M12 portfolio, hoping to expand that to more access for startups over time. And then there's the whole range of other capabilities that we can help companies access, either directly through M12 or through the broader Microsoft ecosystem. So certainly cloud credits are among them. We also have advisory networks. We can make introductions to product or domain experts. And then also we have the group that M12 sits in, business development, strategy, and ventures, has recently launched a series of AI co-innovation labs, where it's actually hands-on keyboard support for engineers who are and companies that are building really interesting things in AI, so that they can actually sit with our engineers and either optimize existing products or test out new things. It's like a very tangible, like practical application of AI with our own kind of Azure and AI experts.
So I know Microsoft is the investor in OpenAI, not
Hmm.
M12, correct?
Correct. Yeah, that's correct.
But is there, is that another part of a potential, working with M12? Hey, we do have, this relationship with OpenAI, and there's obviously some great benefits there.
Yes, I mean, we like to say that M12 investment is like the membership has its privileges if you're in the portfolio, right? So while to your point, we did not invest directly in OpenAI. That was Microsoft, our parent. We do have a very good relationship with OpenAI. In fact, recently we held a portfolio day with OpenAI. So a number of I think 20 or 30 of our companies actually spent a day at the OpenAI offices, walked through their kind of latest product roadmap, did some engineering collaborations, and talked about kind of things that were coming and solving, their individual kind of problems and opportunities. And so that's another example of like ways that we can open access and provide resources to and for our startups. So yeah, we love the OpenAI team and have a good relationship there.
Yeah, that's a huge, huge benefit to be able to have, that
Absolutely.
early access. So
Hmm.
how much is Microsoft CEO, like Satya, how much is he involved? I know that, you guys make your own investments, so I'm not saying he's part of that, but does he have involvement to the degree that you would want him to be?
He is an amazing leader, and we are extremely fortunate to have his support. So we actually do set up a few both showcases, startup showcases for the senior leadership team, including Satya, and also do some startup roundtables periodically throughout the year that we help facilitate. He's an extremely engaged leader. I mean, he really is. It's actually kind of amazing to be in meetings with him. He's just has such a high, he can do the high level CEO strategy and then just dive deep into technologies that are just, I'm sometimes amazed at like his level of expertise and knowledge in specific domains. And then the ability to zoom out again is just, it's really impressive. So we're extremely fortunate to have a relationship with him and his broader leadership team. And we value that a lot at M12, and we try to work towards building that across the organization, not just with him, of course. But yeah, we're very fortunate in that regard.
All right, so the past year, especially, if not longer, it's been a slog for entrepreneurs raising capital. It's been a very difficult market coming off of, blockbuster years of valuations and capital raised. So, I'm under the pretense that, hey, there always needs to be a correction, and having gone through two different cycles, this is another one. And, one would say this is the best time to build a company. So what's your thoughts on the current landscape of the time we're in?
Yeah, you're absolutely right. It's a very challenging time in some regards. I think also historically, I'm old enough now to have been through a few cycles as well, and so a lot of companies, some of the best companies, have been built in those challenging times. And I think my hypothesis is that it forces a level of focus and even frugality to a certain extent on the business side, where you really have to make sure that you actually have something real. Right, the free money days are very much over. They may come back, but I wouldn't count on it. Right, like the zero interest rate phenomenon is a thing of the past at this point. And so free money's gone. So you really need to think about like making the capital you have work and optimizing whatever you have. So I think that's where we're seeing a lot of challenges with companies that have maybe raised at very lofty valuations in the past. A number of them still have a war chest that they're working through, but if your business model fundamentally doesn't work, or if your unit economics are upside down, you really need to get lean or get profitable as fast as possible. And I think for net new companies that are getting built, it's actually very encouraging. I think at the seed stage and the early stages, we're seeing founders that I think understand the landscape that they're operating in and are being very capital efficient in most cases. I think the later stage companies that raised in the ZERP days, like it's a mixed bag, right? We've seen a lot of them have real challenging headwinds or struggle to raise the next round, because they kind of got ahead of themselves on valuation and versus the traction that now investors expect to see at that stage, right? If you're a Series C or D company, like historically there's certain metrics that are associated with being at that level, right? And during ZERP, I think we forgot a lot of that, right? And like kind of overfunded a lot of things. People got a little irrationally exuberant, and you see that even in public companies, right? Like I think the forward multiple on ARR right now for most public companies is like the median is somewhere around like 6x roughly. Whereas during ZERP, it was as high as like 17 or 18x, right? And that's like in line with historical averages, back to like 2005 almost, right? So if you think you're, a 6x multiple on average, or the median, on forward ARR, right? Like that's a very different situation, right? And if you raised at a valuation that was giving you a credit for 17x, right, and now the new benchmark is 6, like that makes for a lot of very awkward situations for companies that raised in that era. That said, to your point, like I think we're seeing a crop of founders and a crop of companies coming out. This could become one of the best times to invest, now and going forward, because I think if you can, also with AI, we're seeing the really lean teams that are very quickly getting revenue generating and getting up to speed, like doing things that ordinarily would take a lot more headcount to achieve. It's kind of incredible to see. So I think we're going to see a lot of interesting companies being built, and certainly we're at M12 we're actively investing, actively deploying capital, and would love to talk to anyone building something transformative.
And when I think of the last cycle, it was, Uber and Airbnb and all these
Mhm.
like anchor companies were built during that stretch.
Yeah.
Um, so the term, I might have just been late to the party here, but ZERP, is that when did that when was that acronym coined? And I hear it all the time now, but I didn't. And I'm like, was I just late to hearing this? Or is this like a new
I,
acronym that's always been around? We knew the time and era
yeah.
of it, but
Yeah.
now people throw that term around like all the time now. I'm just like, did I just not hear this for months, or was I just like,
Yeah, I don't know. I don't know where buzzwords come from. They kind of just enter the zeitgeist, and everyone, it's like you never heard it, and then all of a sudden it's everywhere. I don't know where it came from, but yeah, zero interest rate phenomenon, or ZIRP, ZERP. Yeah, I mean it's basically like the free money era, right, where interest rates were zero and like money was abundant. That is not the case now, obviously. So the cost of capital is a lot higher, so you got to think about where it's coming from, and yeah, I mean it's a totally different environment. I think clearly, in looking in hindsight, is obviously a bubble, right? And like, and thankfully, I think M12 avoided most of that. I mean, we did not get this. I've only been at M12 a little over a year, so I wasn't there in like the peak of the frothy period. But I mean, the portfolio, they were pretty judicious with capital deployment for the most part, and I think we're trying to be good stewards of capital going forward as well. You just have to be aware of the macro climate, right, and kind of what valuations and also public markets, what's happening there, right? There's liquidity has dried up, right? Like the IPO window has been closed for a long time. Maybe it cracks open a little bit, but it's tough, and you need that liquidity kind of to get back into the ecosystem, right? Like every stage, like from LPs, who are the investors in venture funds, and then venture funds invest in startups. And if there's no liquidity, that capital is locked up and it doesn't get recycled back into the ecosystem into new investments, right? So that's also contributing to some of this, some of the challenges in the investing climate. So
yeah, it's a tough road. I mean, I'm not gonna say I had a crystal ball because I didn't. And it's easy to play Monday morning quarterback and look back and be like, oh, I knew it. But I just the number of companies that were raising at a billion plus valuation, I just was like, this is not good. Like this cannot be good. And if you're a founder that raised at that valuation, it's like, okay, now that means your investors are expecting that rate of return. And if you're going to raise another round, that means that you don't want to do a down round. So that means it only needs to be that much greater. Is your business growing at that clip? It just seemed
yep.
unsustainable. Like,
Oh, absolutely. Actually, Sam Lesson posted something recently that I like this framing. It was kind of like um, the like assembly line or like factory line of investing almost, right? It was like just as long as you got through certain stages and got to the next gate, right? Like there was an up round waiting for you, more or less, right, during that free money era. And like like the music is stopped on that. Like the conveyor belt is shut down, right? Like, and so you can't just be like, oh yeah, we'll just parlay this into the next round. Like fundraising is not an outcome for companies. Like that is not an objective. Fundraising, as my friend at Better Tomorrow Ventures said, fundraising is a stay of execution. It is not a goal unto itself, right? Because as a startup, your default is to die, right? Like your default is dead, and you need to generate revenue or get investment. And when you run out of money, like that is the fatal cause of death for all startups. Is like if you're out of capital, like game over. And so the best funding, I shouldn't say this as a venture capitalist, but like the best funding is customer revenue, frankly, right? It's non-dilutive. It shows that you have something. Like that's what you want as a founder. Now, the reason to take venture capital, there are many reasons, but one of the big ones is to accelerate your ability to capture a market or to develop a product. So if you have something that's working and you really want to like accelerate it dramatically, injecting capital so you can grow faster than you would organically, that's the way to do it, right? And then additionally, from a CVC standpoint, there are strategic investors you can add who might be able to add more than just capital, right? Access, distribution, like any number of other things. And so, I think actually for M12 and CVCs generally, like this is a great time. Like, and for founders, I would think, especially if you're a B2B SaaS and selling to other businesses, like, I mean, I think, I'm so fortunate to be at M12 right now. We have not only capital at disposal, but we also have an incredible array of resources that we can put to work for and with our founders. And I think that's a really dramatic advantage for the companies that take our money. So in that sense, it's actually a great time to be investing and a great time to be working with founders, right? But I think as a founder, you just need to know what you're in for and be wise, right? Like use capital efficiently.
Well, typically I ask the question, hey, top three apps you can't live without. But
Mhm.
instead, I want to geek out on one particular product that you tweeted about that I think is extraordinary in terms of what they continue to do. And I just love the brand, company, and it's Spotify. And your
Mm.
tweet was about how they added the audiobooks as part of your subscription.
Yep. They
So,
recently added some audiobook access for premium subscribers. Mhm.
right. So I somehow, I mean, because they didn't really promote it. All of a sudden, I just logged in and I don't know, maybe they were suggested for you like a book. And I'm like, what? And I clicked on it. I was like, wait, I can listen to this now because I had an Audible subscription. Cut that immediately because I'm like, so yeah,
Uh-oh.
like with my family plan, I get 15 hours baked into
Mhm.
my subscription. I'm like,
Are they
okay,
sponsoring this
so
podcast?
they should be, and I'm not encouraging them to charge me more because, but I'm like, okay, you consolidated all my music. Um, my kids, my wife, we're all on the same plan. You eventually got me to switch all my podcasts over to Spotify. I used to have Apple, podcasts. I don't use that anymore. It's all on Spotify. And now my audiobooks on Audible, that's gone. Now my books are here. And like for 15 hours, that's, I'm probably like 12 to 15, like on my way to work. I'm going to listen to a book.
Mhm.
Um, I'm just like, man, this company continues just to really earn my money, and I feel great about paying them.
Yeah. I mean, I have nothing to add. I mean, I think you're right. Like, it's very interesting. It's also interesting. It's still a founder-led company. But yeah, I mean, I appreciated that they just dropped that in there for me. Thank you. I'm enjoying it. I was not an Audible subscriber, but it was a nice way to kind of. I think it's always nice when companies surprise you with like additional value or additional like features that are genuinely useful.
All right. So speaking of audiobooks or books or podcasts, what would you recommend for founders? Any particular titles?
Oh man, putting me on the spot here. Yeah, I really like there are a number of podcasts that I like. Obviously VentureFizz, everyone should be listening to that.
Thank you.
But aside from the obvious, there are actually a number of podcasts that are quite interesting. from some of the senior leadership at Microsoft, not to like be too like plug our own thing, but like some of our, like Kevin Scott has a podcast, like Ian Johnson in cybersecurity. I think Brad Smith has done some episodes as well. So like those are actually quite interesting. They get some really interesting guests, and like, you know, have that perspective. I think on the other side, like Elad Gil and Sarah Guo have no priors, very AI focused. If you're into that, they get some great guests there. I've also I'm just always curious. So the Knowledge Project with Shane Parrish is one that's really interesting. He talks a lot about, like, you know, mental models for thinking and frameworks, and has some really interesting guests on from time to time. So I'd say those are a handful of my favorites.
All right. Outside of work, what do you like to do for fun?
I have 3 young kids, so that takes a decent chunk of time outside of work. That being said, they're a ton of fun though. So I like doing stuff outdoors. Um, I also like cycling. Um, I'm based in Marin, which is just north of SF now, and so I was a road cyclist for a long time, and I still am. But now I've gotten more and more into trail riding, so I try to get out into nature as much as possible. Um,
Very cool. Yeah, I think at Stanford you were a cyclist there too, right? Like,
Yeah, I was on the cycling team at Stanford, and then so I've loved biking for a long time, but I you know, try to get out as often as I can. Not as much these days as I used to, but it's really nice to have access to the trails and just some great riding in the Bay Area overall. Do that, and then when time allows, some music on the side. So like to play the music at home as well. So,
very cool.
yeah,
Well, Peter, thanks so much for taking the time to walk us through your background story, obviously all the great work that you and the team at M12 have been up to, and obviously all the great advice.
thank you, Keith. It was a pleasure to be here, and thank you very much for having me.